The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Oh, looking good, Billy Ray. Feeling good, Lewis. Yes, this is Basil Chapman sitting in for the one and only Larry Pesavento. Big shoes to fill here. Do our best. So let's look at this market. What we're really looking at here is lower lows and lower highs for a number of the indices that were the very, very best. So let's just go one step at a time. The E-mini right now is up 9 at 26.16. This is the E-mini S&P. I'm going to show you something that's very interesting as far as my subscribers to my opening call as my daily newsletter is concerned. And usually I'm doing the noontime hour, the Tiger Technicians Hour, noon Eastern time every day. So it's a pleasure to be sitting in here for Larry. So we're looking at the fourth highest peak from the most identifiable low. The E-mini made a peak D. This is the fourth highest peak. I alphabetized them. I used lettering. Let me just show you this right here. For those of you who are new to my work, I think that's it. Yes. So in the Chapman wave methodology, we try to identify the most obvious lowest low bar, and then we merely count each successively higher peak, alphabetize them, uppercase on the way up, lowercase on the way down. At the fourth highest peak, peak D, other things can happen. That's all you need to know. The objective is to get to subscribers in different time frames from the trough, preferably picking out a buy signal that gets upgraded to a buy mode. That implies you should go to at least a D. You can actually recycle to a whole new fourth set of peaks above that. Not the point. Point is to get you to that first peak. Well, lo and behold, that peak D, the fourth highest peak on the 29th of January at 2883.25, saw this very sharp pullback to 2532, over 350 points. All of a sudden it rallies. It goes to what? A peak A, B, C, and there's your D at 2807.25, and that was on the 13th of March. Pulls back to trough C, trying its hardest to rally. I use moving averages. I use some technical tools. Larry, of course, uses Fibonacci. He uses the Gartley and the butterfly. So it doesn't matter whatever technique you use. Just be very consistent in that. I'm looking at this orange line, the 200-period exponential moving average. It's been under it 4 times. Even today, intraday, it's been lower. The 200-period moving average, this blue line, which most technicians use, I do not. I have it there just to show if that's what other people are looking at. I prefer the 200-period EMA, but look how important the SMA, the simple moving average, is. It held that support. So now this is what I wanted to show you. That peak D is in the weekly chart. This is a pattern that I call the dreaded H in my CD introducing the Chapman wave methodology. This is what we look for. One of the many, many patterns. Lowercase h, if it breaks the left side low, which it did in this little mini h over there, it can go quite a lot deeper, all right? Now, this is a weekly chart, and that's very important. Look, the 120-minute chart made a peak D at 2807.25. So these Ds are very important. I could go through, I'll try to do that a little later on. So many charts that have got Ds. Look, there's a little mini D right there in the E-mini at 2727.25 back on the 20th. And then it has this, what I call a rogue wave spike to an E at 2744, round number high in the E-mini at 4 o'clock on the 21st, and it just plummets down to a trough D at 2586, rallies, goes to another peak D at 2679.75 right here on the 27th at 4 o'clock, and at 2679.75, and now it's come down, and it's in a rectangle pattern. My expression always is, a rectangle pattern can last a lot longer than your patience. Good, got that out the way. Now let's go to some other things. When we're looking at all the different aspects, if you're looking at the QQQ, that's the NDX 100, That made a peak D at all-time high at 175.21. On the 13th, for subscribers, we actually went short that morning right at the opening. Well, the 120-minute chart made a peak D, but it snuck just a little higher to that 175.21 level, and then it plummeted, peak E. Now look at the MACD and the stochastic, how badly they pulled back, and now it's trading at 158.36. And what I said to subscribers on the way down, we took 22% profit, just a little bit off, because how can you not hold that core position from the $1 from the all-time high? I mean, at least we've got good risk reward, and it looks like the tech sector is very vulnerable. So I'm anticipating lower lows and lower highs in this sector, but shorter term, I even said at 33% profit now. If you want, just take a little bit more off, but we want to hold the core position, and we're probably going to add on a big bounce, maybe in the semiconductors or in the QQQ, the NDX 100 vehicle. Now, let me go through these things. If you're looking at gold, gold has pulled back pretty sharply. It made right here, it made a peak D a year ago, another peak D in gold, and the continuous contract on the 25th of January at 1,376.4, and it's pulled back very sharply, went to a trough D, and then it landed up reversing off just above the 200-period moving average in the weekly, in the daily, and now it's fading again. And that says, hey, wait a minute, have a look at the dollar. Is the dollar about to have a change of trend, a more serious trend that could in fact impact the currencies? For the first time, it might be influential in impacting the general market, and that would be the multinationals. So a lot of things are going on here. Make it real simple. I'm going to say that if the dollar breaks, it's at 90.03, down 7 cents after a strong 2 days. The weekly charts is the middle one. So the daily on the left, weekly on the right, in the middle, monthly on the right. Monthly looks very poor. The 120-minute chart looks quite good. Let me get rid of this. I want to show you something else. If the dollar closes at any point in the next week and a half above 91, that'll be really positive. It'll start leg B in the weekly chart and help the monthly chart. If it closes below 89, so 1 point up or 1 point down, basically, going to make a big difference as far as I'm concerned. Otherwise, we're looking at a rectangle formation can last a lot longer than your patience. Look at the EUR USD. It was acting quite well just 3 days ago. Now it's pulling back, stuck in this range. This weekly chart shows the range. That circle says, hey, you can last a lot longer in this trading range between the 1.25s and the 1.21, I believe, yes. And at this point, at 1.23, it's just kind of stuck. But on a very short-term basis, I would have to say that a push above 1.238 would say, hey, that's good. You can try to work your way up to the 1.245 area. But if there is a pullback under the low that was made on the 21st of March, be really careful, because that arch formation says dollar's going to rally more, and we'll see the USD JPY, which is the yen, the dollar-yen currency pair, is attempting to break to the upside. I'll talk a little bit more about these because I think this is a very important period for the currencies. Basil Chapman sitting in for the one and only Larry Pesavento. I'll be right back. The Dow futures up 87, S&P futures up 10.
The TAS Profile Scanner Plus, developed by John Logan and his team, is a standalone piece of software that can change the way you trade. Let the TAS Profile Scanner work for you by scanning over 5,000 financial instruments such as stocks, ETFs, commodities, futures, and Forex. Right now, you can get a 30-day free trial to the TAS Profile Scanner Plus right at TFNN.com. And when you sign up, you gain instant access to John Logan's most recent webinar, How Price, Volume, and Time Make Market Profiles So Unique. This hour-long webinar with John Logan will walk you through the most powerful features of the scanner and how you can use it to become a more successful and profitable trader. You pay absolutely nothing for 30 days while you try out this software risk-free. For more information on the TAS Profile Scanner and to get your 30-day free trial today, visit the front page of TFNN.com.
Many of our new listeners have heard about The Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive The Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on The Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Nothing like being introduced by a Mozart overture. Wow. Okay, so look, just before we go to callers, let me show you 2-minute chart of the E-mini. Peak D pulls back. Peak D pulls back. This is the 5-minute chart. It actually went to a rogue wave G and it's pulled back sharply. The 10-minute chart made, look at this, fascinating. It's got one peak D, 2 peak D, 3 peak Ds and sharp pullbacks. So I'm just trying to show you how powerful this is. And I'm giving a webinar on April the 3rd, 6 o'clock to 7:30 for in the evening Eastern Time for subscribers to my opening call, but you can become a subscriber just by signing up. It's really basically free, because if you don't like it, it's a money-back guarantee, but you'll get that webinar, and it's the power of the 4th highest peak in the Chapman wave methodology, the peak D, and you can recycle and keep going higher, and it's going to, the timing of this, with the peak D and the Qs just right through the board. Amazon, you can just go through all the major charts, semiconductors, and we'll be talking about that. What's the implication going into the summer? Let me go to our caller. We've got John in Philly. John, how are you?
Thank you for taking the call, and thank you for filling in for Larry Pesavento. It's always a delight to see your market perspective ahead of the 9:30 cash open.
So, what can I help you with?
I would like to ask you, please, about U.S. Treasury yields and your triple yield chart. Specifically, Basil, I've got this question. As I'm looking in Tiger TV now at your triple yield chart, I can see your weekly chart of both the 30-year yield, the 10, and the 5, and I notice that back the week of February 19th, the 30-year yield made a peak C on the weekly.
Correct. Yes, it's 32.21, 3.221%. Correct.
The 10-year made a Chapman wave peak D.
That's the TNX 10-year. Yep, the brown one. Yes.
My very specific question is this, please. Now that 5 weeks have elapsed and those yields have come down a little bit, not much, but a little bit, is there anything in your work that can tell us on that 30-year yield and the 10-year yield if this pullback is just about to bottom out before turning back up, or if it's likely to pull back lower further.
Okay, so let me just, for those people who are perhaps listening but aren't able to see the charts, there's a black background chart. I've got a white set of price points bar chart, and it's made a peak C at a recovery high above all the highs that were made in 2016 and 17. It went to 32.21, 3.221%. That's a peak C at a new recovery high. And that implication here is that there should be a D. There almost always is once you've got a buy mode in place. So just keep that in mind. But what's really important is that these are the really, just had to lubricate the throat. The peak D that was made in the 10-year, the TNX, the brown one, and the 10-year has pulled back sharply below the lows that were made over the last. This is the lowest low, and it's in a leg B to the downside, lowercase b, just like the 30-year is, the white one, the TYX. But the 5-year, these two are the most important, the 10 and the 5. This is where many of the, it's the benchmark for many of the interest rates in, loans, mortgages, all sorts of things. So it's very important. That went to a D and then popped to a peak E last week and has pulled back. Now, John says it's pulled back fairly mildly. In my work, if you look at the big picture, it's mild. But if you're looking at the shorter term, this has given back a lot of the gains that were made. So we're kind of back where we were a month and a half, almost 2 months ago. So this is saying to me, we've got to keep in mind that there's an outstanding of the weaker of the three yields. The 30-year is the one that maybe could abort a move. I don't think it's going to. I'm just saying it's more important that we got the D and the E in the 10 and the 5-year to tell me, and now I can do this. This is a weekly chart. So I'm going to answer your question by going straight away to the daily, weekly, and monthly of these, and I'll show you something very interesting. If I go to the TNX, which is the, in this case with the white background, this is the 10-year yield. It's trading at 27.70, down 5 cents. It made a double top. 29.43 was the peak E daily high on the 21st of February. And it's pulled back pretty sharply from there, 29.43 to 27.70. That's it. It's taken time, more than speed, but it's a pretty big pullback. What's really important is I'm following the weekly chart. And the weekly chart, MACD, the moving average convergence divergence, has made a very powerful move to the downside in the faster moving average. That's the 9-period differential, the green line, hasn't crossed negative to the red line, and the stochastic is still above 80% at 83.76. So far, those pure technical tools are saying they're okay, but they are turning down, but they're still in good positive territory. What I'm looking at is the peak D that was made in the weekly chart back on the week of the 23rd of February. This is now a leg B in a weekly chart. There's almost no chance today. I shouldn't say that. There's very little chance that we're going to close. Let's see what happens. I shouldn't have said that. Above 27.93, the 9-period exponential moving average in the weekly. If the weekly chart closes down a little bit, a couple of things are going on. Now, you remember, I've spoken about this on my show, and I've said a couple of things. One is that I'm putting a lot of weight, that's WEIGHT, on the 10 and the 5-year, because I think they're the most important, number one. The 10 and the 5-year have broken, especially the 10 has broken a multi-decade down channel in the monthly chart and closed above it. But this is just the first time. Now, what is really, really important is that in the weekly chart, if the TNX closes below 27.93, until the MACD crosses negative below the red line, the slow-moving average, and the stochastic goes under 83%, I still have to wait before I can put a down arrow. In the weekly chart, if I put a down arrow, it's implying there's a sell signal. If it closes probably I'd look at this because it's so important. I'd be more conservative. If the TNX closes 2 weeks in a row below 27.90, let's give it a little room. Let's say below 27.70. If it closes below that number for 2 weeks in a row, and the MACD crosses negative, and the stochastic crosses it goes under 80%, closes on a weekly basis, I'm going to have to put a down arrow, and that's going to say, goes to my second point that I was going to make, and that is my contention. It's historically accurate in some periods, not in others, but my contention has been that money will flow from the volatility of equities into the so-called safety of bonds if the market continues to make lower highs and lower lows. So am I answering some of your question?
That's very helpful. I do appreciate that. I will hang up and thank you very much. If you have the opportunity to show the TYX, I'd appreciate it.
I will. Okay.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. I was just asked by John if I would put in the long-term TYX. This is the 30-year yield. Look at this. It's so fascinating. I love to do this. It's so simple to put in straight lines. These are trend lines. Look how the since 1997, it actually goes back even before then. But I'm talking about the actual channel itself. That the bond yields, the 30-year yield, has been like bonds, has been in a downtrend. for forever. I mean, since it's been in a downtrend since the night crash of 1987. But basically, this channel, can you believe, how does the yield know that it's in a channel? And it's been absolutely faithful to it. Once it went out of the channel in 2008. Of course, we had the crisis. But look at this. And it still hasn't broken to the upside. That's very different to the TNX, which is the one that's very important. Look, the TNX has broken that channel line. This is the 10-year Treasury note interest rate. It has broken. So I just wanted to show that. And my contention has been, at least for 20 years, it's actually much more than 20 years, that we are in the Japanization of our bond yields. That's what I'd call it, meaning that we too would go to 0%. Now I think there's a slight change, but we haven't broken out yet. We are starting to show that yields are going to become more important. So market is open. Let's get to the nitty-gritties right now. I've shown you the E-mini. Look at this. It's gone now. It's broken to a new high. The 5 minutes has gone to a new leg C. So we've got, I said to subscribers, that's why I said take something off the cues, because very oversold short term. End of the month, end of the week because of Easter. Happy Easter, everyone. Happy Passover. And we've just broken out. Here's another technique that I show. It is the left side, right side price time match. Look at this. I drew this in earlier in the morning. E-minis, I like to trade E-minis, although lately I've been working more on the Russell 2000. Now look at this. You see from that high that was made right there, at 12:30 on the 20th, is that the 8th? Yeah, the 28th at 2633.7. The level that I chose for a left side, right side price time match was these highs right here, going to 2621 and 2624. And I chose to go to the back wall of the I call it the Grand Canyon cliff right there, and I chose the lobe right there as a trough to count, and I made a pattern that said there should be a test of that level by about 9:20 this morning, where it was two bars late. We just did that right as we're speaking. Now, is this just an opening salvo with people saying, hey, this is the end of the month, I haven't done all my positions, I've been waiting, the market's so choppy, didn't know what to do, I better get in while I can, and then this is maybe the high of the day? Or is this saying, hey, this is going to be a really powerful move? So what I want to do right now is to look at the volatility index. Look, the VIX.X, it had popped a little bit. It actually has not been even close to the rally that it had back on the 6th of February when it screamed to 50.30. It almost made a leg D to the upside above 26.01, the high of the 23rd. It's kind of struggling here. It's holding the 9-period moving average. I think that the next hour and a half is going to be very important. But most important that I'm looking at is when you look at things like the SMHs, the semiconductor, had a leg D to the downside. It just deserves on the 120-minute chart. Let me just get out of this right here. It just deserves to have a bit of a bounce, and that's what it's doing. It's just a bit of a bounce. I think that the whole tech area is vulnerable to selling in April. How long, I'm not sure, but they've already started to move down. The QQQ series tried to rally. It's up 81 cents at 158.10. Wow. It really needs to get to the 161 to 162 area by Tuesday or Wednesday of next week to say this stick, MACD, is so wide, the distance between the faster moving average and the slow moving average, and the histogram, the vertical bars, which denote the distance between these two lines, is so big that the stochastic is at 12%. It is struggling to get a move to the upside. Oversold, yep, it's in leg D. It should move. We'll see. The day is young. I'm just saying to you, over the next 3 days, the Qs better hold the 155s. Otherwise, there's a real problem. Next thing I wanted to show you is, within the context of the different markets, the crude oil's made a peak D. How many peak Ds are we going to see? There was an unusual peak F at the top back in February, pulls back very sharply, goes from the 66s down to the 57s, touches 56s, rallies back up, makes a peak D, and now it's just holding with a high-level consolidation. It's the monthly chart, the weekly chart that is really fascinating for me. Is this a G or a brand new B? And the way I'm looking at it is that from the monthly chart, it's very interesting. Sometimes you want to go from the smallest chart to the smallest time to the longest. I love looking at my monthly charts because the monthly chart says, look, you've broken out, talking to the crude oil now. You've made this lowercase h that goes to a lowercase m. At the same time, there's really a kind of a very slow move to the upside in a bowl or cup formation. So in this particular context, any move above right here in the continuous contract, I was looking at the continuous contract of the dollar before. This is a continuous contract of crude oil. 66.55 was the high in January. It made a fractionally lower high of 66.19 in February. That makes it a peak C. And now we've got a high of 66.55. So far, this is a peak C1 with a leg C2. It has to go 1 penny above, 1 penny in a long-term monthly chart to make a leg D. That's all it needs. So I'm watching this closely. The MACD, the moving average convergence divergence, is moving up, not with a big move in the price, and that's a pity because it's usurping energy, talking about energy and crude oil, and it's usurping that energy. Stochastics at 89%. Crude oil actually should be in the 73 area based just purely on the technicals, and that's showing that there's a lot of oil out there. That's my guess, and that's why oil is holding okay because of the way it's marketed. That's the way it's sold. That's the way it's distributed. That's the way the politics works. But it's not breaking down. But so far, it's not breaking upside. So I'm watching it very closely. If it goes to the 67s, the 200-period moving average, I'm going to say that's quite positive. And crude oil could actually go a little higher. So we've got a bunch of things that we're looking at here. I want to look at high-grade copper. High-grade copper, nice move to the upside, leg B in the daily chart after making a leg E, a trough E on the downside. I call these gray letters because gray can fail at any point. So it's a gray A and a gray B. And this is a good sign because it says copper hasn't really broken down. In other words, it did go under 3, but it's back above 3. And look at this cup formation in the continuous contract of the weekly, of the monthly chart. So copper's holding okay. Dow's up 182, S&P's up 16. We'll be right back. Basil Chapman sitting in for Larry Pesavento.
Would you like exposure to the foreign currency markets without any downside risk to your principal? Then consider the Petro Currencies Market Safe CD from Everbank. This 3-year U.S. dollar-denominated CD leverages the performance of 4 equally weighted currencies from these top oil-producing countries: Brazil, Canada, Mexico, and Russia. This CD features a 200% leverage factor, which means that your potential upside payment will be double the currency's average performance at maturity with no cap if the currencies increase in value over the CD's term. And if the returns are negative, your principal's 100% protected. Returns are based on CD performance with no correlation to the price of oil, and there is no annual percentage yield or periodic rate of interest on this index CD. The April 19th funding deadline will be here before you know it. So call 1-855-750-4051 or visit everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. This advertisement is sponsored content. Everbank is a division of TIAA FSB, member FDIC.
TFNN has put together the finest programming lineup each trading day, featuring some of the most knowledgeable and respected financial minds in the nation to educate traders and investors. On Mondays, Wednesdays, and Fridays, we broadcast 8 hours a day, starting at 9 a.m. as Larry Pesavento kicks us off with Trade What You See. Tuesdays and Thursdays, we broadcast 11 hours. Get an early and healthy start to your day as Nico and Paige bring you Living a Primal Lifestyle. Then catch Andy Hecht at 5 p.m. with the Commodities Hour, following the Tom O'Brien Show. Swim lessons from TD Ameritrade Think or Swim is now at 11 a.m., followed by Basil Chapman at 12 noon. See the TFNN program lineup via the link on the front page of TFNN.com to get a complete overview of our TFNN shows and hosts. And keep TFNN's Tiger TV tuned in on your mobile device, PC, or Mac for the latest financial news and information throughout the broadcasting day. TFNN.com, educating investors.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Binary Option Hour, brought to you by Nadex. Next on TFNN.
So talking about the Ds, the NQs, the continuous contract, made in the 10-minute contract, it made 2 peak Ds. Now what I normally do is if I was trading, I take the time. I promised myself always to take the time to do this, and it's called the left side, right side price time match. And I'll show you exactly what I do. I like to make it a midpoint. In this case, it can't be a midpoint. It just doesn't work that way. So I do it this way. And it says there should be a test of this low, the low of at 1:30 this morning in the NQs, the continuous contract of 64.76, and it should be by 10:50. Well, we're about to do that right now after that peak D. So these are techniques that I like to do. I'll be talking about some of them in my webinar because the implications are what happens with the H pattern or the arch formation. What happens? Look at this. I had an email from Bob in Framingham saying, I dare say the weekly S&P chart shows that the fundamental character of the market has changed. Well, that's what I don't know if Bob was listening, or was that? No, that was before the show. So he sent that to me before 9 o'clock. Yes, this H pattern is deadly. Look at the MACD and stochastic in the S&P. It's not that. Okay, I think I'm going to take the time now to talk about this so that if you want to listen to my show at noon, I'll follow up on that. I'll talk today. Usually it's Friday. I talk technicals. I call it the Chapman Wave technical analysis. We go a little deeper into the methodology because there are so many people that use the Chapman Wave. In fact, I just got corrected in the Qs. It's in leg D. It was a leg D down, not a C because I missed one. So look, this is a peak D in the monthly chart of the S&P index. This candle right here, I'm just going to show it if you don't mind. I'm going to switch to the Dow because I've already notated it. I call it the Chapman Wave Roman candle. It's a particular technique I developed years and years ago, and I won't do it right now. I'm going to just keep talking about this particular time frame because it happened in 2008. That Roman candle was the clue that we would be going down. Now, what's really important about this is that in this particular candle, and it usually occurs right a bar or two after a top is made, a serious top is made in whatever time frame. If this happens, and then the very next, in a shorter time frame, in this case it's a monthly, so I said to subscribers, and I said on air, that if on a weekly time frame there is a close below 24,300 to 24,200 cushion, I said let's make it 24,200 on a weekly basis, that would suggest we're going to go down and probably test the low of 23,360. The rule of thumb with this particular candle is that a close in a shorter time frame, halfway, below halfway of the lower wick, suggests that you're going to go to exactly on or just below the wick and then have a pretty decent bounce. So what we're looking at here is that we are at this point up 159 in the Dow at 24,008. We've already gone this month to the 23,509 level. That's pretty darn close, but I am just watching this very closely because I'm anticipating, with a couple of things going on, that in fact, and I'll be talking about this, what we should be looking at for the rest of April, going into early May, and what about the summer? Can the XLK, that is the S&P Tech Sector ETF, is that having a well-deserved rest? Will it continue? Are these techs, look at this Amazon chart, Amazon goes to a peak D at 1617.54. Then the following day, this is in the daily chart, the following day it opens at a round number 1597, and then the very next day with another red candle, it opens at round number 1595, and now it's trading at the low of the day of 1385. I mean, down 45. Peak G, unusual peak G in the weekly, leg E in the monthly. The more I look at these charts, the more I'm convinced that the high-tech sector, the tech in general, are quite vulnerable. Maybe they've done a lot in price up until now, and it's just time. Usually when the weekly chart turns down like this, and Amazon's been the leader. Look, right up in 3 days ago, it was just within a hair of its all-time high. It went to 1575, 60 points off the all-time high. Now it is almost 300 points below that. This is not good. So, and then you can go look at Google. I love to say Google because it's very hard for me to say Alphabet. It made a peak D in the last move to 1177 with a Chapman wave 2-bar reversal, and now it's trading at 1005. And it's got a peak E with that big H pattern, fading H pattern, went to a lower low, and then the left side, peak E in the month. I have to tell you that the more I look at it, I try not to because I love to be more bullish than bearish. I mean, bearish is not fun, even if you're making money and subscribers are making money. It's just not fun because people get very gloomy. If you remember that whole period of 2008 and 2007, not good. So all I'm saying is that as far as I can see right now, there are vulnerable sectors. If you look at the RTH, and a lot of people have been talking about retail is coming back. Retail, I don't know about retail coming back. Some retailers are. This is that H pattern at a peak F. I'm going to change that because it's an F right now. Peak F in the weekly chart of the. This is the market vectors, the Van Eck Vectors Retail ETF. Peak D in the monthly chart. How many Ds? This webinar on Ds. I mean, I started writing them down for my webinar, and I just have to stop some of this. It's just too many. The pattern of the H, it's formidable. So this is what I'm looking at. Within the context of the markets, I think that we're in, because of the weekly Dow, weekly S&P, and maybe the weekly Qs, we'll know at the end of the day today, but I can start to guess. I think the dailies have already gone to sell mode for quite a while. We're still short for subscribers, short the Dow, and we're short the Qs, and we're short a home builder. Why a home builder? Because let me just finish the Dow weekly. This suggests very strongly from the weak technicals that the WEEK, the weekly chart of the Dow, the weekly chart of the S&P are pretty vulnerable, even if there's a bounce, to retesting the lows of February. And if they break the lows of February, they go even lower. But wait a minute. When we go back to the Qs, look, the Qs are, that's not a good pattern in the weekly chart. Peak F plummets to the gaps down, comes down. Look at the technicals, not good. Hey, look at the IWM. IWM right now, peak E in the daily. But wait a minute, it made a peak F at 160.63 on the 24th, pulls back to 144. Hey, I would say that a 16-point pullback is pretty deep. Rallies all the way back to 160 point, what did I just say? 160.30, 33 cents off the all-time high for a double top, Chapman wave double top pattern. And now it's pulling back. So even the IWM, which had a better pattern, even the monthly chart is still a better pattern than most, is somewhat vulnerable here. So I'm very cautious, even though I'm anticipating that because of the oversold condition in some of the techs, you can get a pretty good bounce at any point. I'll be back. Basil Chapman sitting with Larry Pesavento. This is.
You don't buy into that nonsense, do you? You know you can't time the markets. I didn't. And in 2006, I set out on a mission to do just that. I began by surrounding myself with the greats like Tom O'Brien, Larry Pesavento, David White, and Basil Chapman. I read countless books and even looked to the moon and planets for answers. Now, we both know that trading is 80% mental. So I learned the exact tools that Tony Robbins uses to overcome fear. I'm Steve Rhodes, author of Mastering Probability. And last March, the folks at Timers Digest began tracking my newsletter signals, which through January 18, 2018, placed me as the #1 gold timer for that exact time frame. Now, I can't officially be recognized until Timers Digest has a full year of signals, but clearly I've learned how to time the markets, and I'd like to teach you how to do that as well. Subscribers to Mastering Probability gain access to my live and archive workshops where I show you the exact same patterns that earn me this #1 ranking. If you're looking for great market calls and an education, sign up for Mastering Probability today at TFNN.com.
No matter what kind of trader you are, 2018 is a great time to try out a subscription to Tom O'Brien's Gold Report. Whether you just plan on diversifying your portfolio with some exposure to gold and gold mining equities, or you're a gold bull that sees 2018 as the year of commodities, now is a great time to sign up for the Gold Report. Tom O'Brien publishes his Gold Report every Monday morning before the market opens and covers a variety of topics including gold, silver, platinum, copper, the XAU and HUI, the dollar, bonds, South African rand, as well as more than 20 of the most actively traded mining equities. Start your 2018 off with a bang and sign up for the Gold Report today. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. For all the details and to start your subscription right now, visit the front page of TFNN.com and you'll find the Gold Report under Investment Newsletters. Basil Chapman has just announced that on Tuesday, April 3rd at 6 p.m., he'll be hosting a special 90-minute webinar for all of his subscribers titled The Power of the Fourth Highest Peak, the Peak D in the Chapman Wave. During this 90-minute live webinar, Basil will be discussing how to use the fourth highest peak, the Peak D, as a heads up for either a directional reversal of consequence or a momentary pit stop for further gains in the Chapman Wave. He'll also be going over what the weekly and monthly implications are for the key indices with their peak Ds and even peak Es, together with the H pattern in the Chapman Wave that he's been following for weeks with his subscribers. Now is a perfect time to sign up for Basil's daily trading service, The Opening Call, while gaining access to the April 3rd live online webinar. Remember, all new subscribers get a 30-day money-back guarantee, so you have nothing to lose. For all the details and to sign up today for Basil's Opening Call, visit the front page of TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi folks, we're back. So I had a question here, Basil. I only have the downturn in IWM, that's the Russell 2000, at the 0.618 of the move off of the February 09. Am I missing something? So look, if you, so 160.63 on the 24th in the Russell 2000 iShares, plummets down to 144.24, skyrockets to a peak D, and then has a rogue wave move to the top with a silent doji candle, Chapman Wave silent doji candle the day before the high of 160.30, perfect double top. Look at that V-shaped pattern. I call it the Groucho Marx eyebrows. Don't have to go into that right now. And it's come down. It hasn't broken down. That's what I'm saying. The IWM has held better than the others. If maybe next week there's a bit of an oversold rally, this should participate and then stall somewhere in the 155s, 150. No, I don't know if we can get there. Let's say 154s. Let's see what happens. So I hope I answered that question. So we've got... this is the final segment before you go to Tom and Tommy. So I'm just going to say a couple of things I'm looking at. The VIX index was pulling back, is now less than it was. It's down 83 cents at 22.04. This is the end of the day, end of the month, end of the week, end of the month. And I think there could be some buying to hold the market. But if the volatility, if the Dow gives back its big gains and is only up at, I said to subscribers to my opening call, if at 10 minutes past 11 Eastern time, if the Dow is up 50 points or more, that says could be a good close. If it's less, if it's only up 20 or less than that, that's just not good at all. And just keep that in mind. You can base it on the Dow, at least for now. But right now, the VIX is saying there's still some buying pressure. Keep in mind there's still buying pressure. And on a weekly basis, this is going to be, again, a close above the 18.81 weekly chart, 9-period exponential moving average. And that's just saying someone out there is already wanting insurance. And that's the way I'm looking at this. I think markets are vulnerable looking out a few weeks. Still vulnerable. Hey, thanks for being here. Basil Chapman for Larry Pesavento. Have a wonderful weekend. Happy Easter and happy Passover. I'll be back for my show.
Hi folks, Tom O'Brien here. If you'd like to get my daily newsletter, Market Insights, then now is a great time to sign up for a 30-day free trial. Every morning by 9:30, I send out my morning letter to subscribers with market commentary on a variety of markets, currencies, and commodities to keep investors up to date on the day's trading action. Included in Market Insights are specific buy and sell recommendations for stocks, ETFs, and even options, with stops and price targets included for every trade in my newsletter. If you'd like to try my newsletter risk-free for 30 days, then head over to the front page of TFNN and you'll find Market Insights under Trading Newsletters. I use my years of trading experience to bisect and dissect the market every morning and give my subscribers the most important information they need to know for the day ahead. I even issue afternoon updates for my subscribers whenever warranted with important market action. I'm always scouring the market for the next great trading opportunity. Sign up for your 30-day free trial to my daily newsletter, Market Insights, today by visiting the front page of TFNN.com. Wow! Go get 'em, folks.